I don't know with certainty that the 10-year at the time that this video comes out is going to be below 4%, but the fact that it did peak below 4% over this last week has been surprising to, I think, a lot of market watchers. And it's true also that 6 months ago, the concern was that inflation was going to perk back up, that the Fed had declared victory too soon, and tariffs were going to be an issue with inflation. And also the fact that Doge kind of came and went, and all of a sudden all of this focus on government cuts and reducing the deficit all of that just kind of went out the window. And so there was all these new reasons to be focused on inflation again. But in reality, inflation is remaining subdued, and growth is also unfortunately kind of being called into question. And we've had a reduction in energy costs. That's something that doesn't seem to get mentioned that much. Oil is down quite a bit, which means gasoline prices are down quite a bit, and that's a huge contributing factor to inflation. So is it surprising? Not entirely. The front end of the curve has fallen quite a bit more than the long end, but yeah, it's not entirely surprising to me. This is something that I've been sort of waiting for, watching a little bit to see if there is a change in market leadership, because when you turn on Bloomberg, CNBC, any financial publication, the front page is about tech, and mostly AI. Something related to AI and tech is that's what investors are looking at. It's front and center. But at some point, the sort of the fuel runs out of a move, and I think people would maybe be surprised to learn that over the last 3 months, the market leadership is not technology. It's actually healthcare and biotech and consumer staples. Those are actually performing better than a broad index of tech stocks. So, and that is sort of how this happens. You know, we've had 2.5 years roughly of NASDAQ leadership and just, up and to the right. And it's not that these stocks are falling apart necessarily, but they're sort of stagnating. NVIDIA, which was the only thing anybody wanted to talk about, is in the same place as it was 3 months ago. So it's not that the company is doing poorly, but the stock price sort of maybe got ahead of the company's fundamentals. And so what we're seeing now is that these sort of left for dead sectors that were probably seen as boring to investors are starting to come to life a little bit. I think it's too soon to say anything about energy, but the last week or so, energy has sort of maybe shown a little signs of life. So it would be interesting if we have a rotation under the hood of what's happening. The market isn't really moving, but to see some sectors that have not been getting much love generating some positive performance would be interesting, and I think it would be healthy. It's not that I made any kind of prediction in our previous video. It's just sort of like that is what's happening. The short end of the curve is significantly lower than it was 24 months ago. And while mortgage rates don't necessarily respond to the short end of the curve, they do respond to the 10-year. And the 10-year has fallen less than the Fed funds rate, but it has fallen. So, and that sort of makes reference to the idea that the curve is steepening, which is a good environment for banks. So yeah, I think we are in, whether it was by design or not, we're find ourselves in a situation where the housing market could have a little resurgence. Rates aren't back where they were in the depths of COVID, and they maybe never will be again, but mortgage rates around 6 is a big difference from mortgage rates around 7. If you just do a quick calculation of what your monthly payment's going to be on a new purchase, it's meaningfully different today than it was 6 months ago. And again, sort of echoes from the previous video. I don't think people are getting excited about a refi. I don't see a refi boom, but for those who've been on the sidelines about either upgrading to a slightly larger home or maybe making a first-time purchase, we're getting there. We really are getting there. As long as employment stays roughly stable, and I think that's the thing that's maybe a little bit of a concern. It's not a concern today, but the trend isn't favorable for employment. So but I can see a reason for people to sort of rush and make a home purchase now. In my opinion, I think the time for a decent rate of return on 30-day T-bills or money markets, I think the time has passed. The rate is no longer super compelling after taxes. And I think it's really hard to say that we're going to see the entire yield curve move down meaningfully over the next 2 years, but that could happen. That is sort of the current administration of the Treasury Secretary's goal, is for lower rates to help basically finance our government's operations and deficit. And I think it's an important conversation to protect yourself against that if you are a fixed income investor, especially if you're a fixed income investor who's been really leaning on the short end of the curve. If you haven't locked in a portion of your portfolio longer term, I think you really need to consider doing that, because the rates are still compelling, especially if you're looking at munis, municipal bonds. 15, 20, 25-year municipal bonds, you can get a meaningful rate of return comparable with what you were getting on the short end of the curve just a year ago, which maybe doesn't sound like a great deal, but it is, because you're locking in 15, 20, 25 years worth of a pretty compelling interest rate, especially if you're with municipal bonds, they're tax exempt. So I think we're at a really important inflection point for fixed income investors. What could go right? It does sort of feel, it feels like the bottom could fall out at any moment, even though the market volatility is very low. I mean, we had a little bit of a spike last week when there was a down 2.5% day, and then right back up. But it is interesting that we're getting sort of nervous questions from clients, like things are too good, this can't last. And what could go right in response to that sort of sentiment is, and I feel like I'm a parrot. I've said this the last couple of videos, is maybe things don't fall apart. To me, that would be things going right after the run up that we've had in the stock market the last 2.5, 3 years. Not having a crash would be things going right. Maybe similar to the analogy that a couple questions ago with NVIDIA. The stock is in the same place it was 3 months ago. The company obviously is still doing just fine, but the stock, basically the company's fundamentals have caught up to the stock price, or in the process of catching up. Maybe that's what happens with the broader economy. Maybe the stock market's gotten a little bit ahead of itself, but it doesn't fall apart, and we've got a period of the economy sort of catching up to it in a way, where the labor market becomes a little bit more healthy with the help of this stimulus of lower rates. That does help companies that are relying on short-term cash and funding needs. If the costs for that go down, that companies can maybe reconsider having to make spending cuts. Another thing that could go right is that the market leadership reorganizes itself, which is also something that we discussed on this video. Maybe tech doesn't need to keep leading us for the next leg higher in the stock market, and maybe bonds provide some positive returns, which we've started to see the last 30 days. So a diversified investor might continue to have a good 3 to 6 months from here, with the help of some unloved sectors like healthcare, energy, consumer staples, and fixed income. And to that end, should technology not be the leader of the market for the next 6 to 12 months or longer, then it's important to have exposure to some of these other sectors. And for people who have been all in on tech, or maybe you weren't even all in on tech, but you weren't paying close enough attention to rebalancing your portfolio, and tech has all of a sudden become 50% of your portfolio and you're approaching retirement, that's that's something that requires attention, in my opinion. And so obviously you want to pay attention to taxes as well. But this could be a really great opportunity to do some rebalancing, especially in retirement accounts. So I think that's something that could go right, is you've got the opportunity now to really take a look and do some rebalancing to put yourself in a position for the next 6 months.